Good morning. Welcome to the Antipodes Global Investment Company Shareholders Conference. Your hosts today are Jacob Mitchell, Chief Investment Officer of Antipodes Partners, and Andrew Findlay, Director of the company and Managing Director of Antipodes Partners. Go ahead, thank you.
Thanks very much, and welcome shareholders to this call, recapping the half-year results, the first half-year results for financial year 2019 for Antipodes Global Investment Company. My name is Andrew Findlay. I'm, as Lisa said, a director of the company and also Managing Director of the underlying manager, Antipodes Partners. Alongside me, I have Jacob Mitchell, who's CIO, and Jacob will be talking a little more about investment performance and the portfolio in a moment. I'll start by talking through the company level results, starting on page 2 of the presentation. I should say that the presentation is available in a number of places. Firstly, the Antipodes website, antipodespartners.com. Also was emailed to those of you who happen to be on our mailing list. It's also available on the ASX website, as was uploaded there yesterday. Okay, so to page 2 of the presentation. Firstly, just summarising the results for the first half. The company recorded a loss in the first half of 19.3 million, reflecting the weaker global equity markets during the period. Over that same 6-month period to the end of December 2018, the portfolio declined by the underlying portfolio of securities declined by 3.1%. However, did outperform its benchmark, being the broader global equities index, over the period by about 1.4%. On the right-hand side of that slide there, the company NTA performance, which also reflects other capital management at the company level, including the dividend paid in the second half of the year and the options dilution over the period. The company NTA declined by 9.3% over the 6-month period. I'll talk about that a bit more in a moment. The board also resolved to pay a dividend, an interim dividend of 2 cents per share. You can see there at the bottom of the slide, franked to 50%, and that combined with the final dividend for FY18 of 5 cents a share equates to an annualised yield of 6.6% using the trading price of 20th of February. If you just turn the page to page 3, you can see the NTA movement over the course of the first half of the year. Clearly, the biggest impact on the NTA over the period is related firstly to the portfolio performance, declining in line with global equity markets. The dividend paid of 5 cents per share, as you see in the third bar from the right, and then the options dilution, which occurred late last year. The options are now expired and out of the way, so we don't expect any other movement in the NTA going forward from any form of options dilution. Over to page slide 4, some further detail on the dividend. So the ex-date 7th of March, payment date 22nd of March. Company's market cap today is just under 600 million. The option conversion that I mentioned earlier, as you're all aware, when the company IPO'd back in 2016, there was 1-for-1 option issued to shareholders who came in at IPO. 93.6% of those options ended up being exercised, which greatly increased the number of shareholders in the company over the period. So we're now over 9,000 shareholders in APL. Slide 5 is a summary of performance since inception of the company, just over 2 years ago. I'll just start with on the right-hand side. You can see how global equity markets have performed firstly over that period, up 23.1% over a little more than 2 years. The middle column reflects the performance of Antipodes portfolio, broadly keeping up with global equity markets over the period, but despite having a net invested position of around about 60% since inception. That means we have a degree of insurance in the portfolio, which helps us manage or mitigate down markets. You can see that in the up market, down market capture statistics there. The 75 number means in any month where there's a down market performance for equities more generally, the portfolio captures 75% of that down move. That's 86% of the up move on average since inception. That's a reflection of the long-short strategy that's employed. The left-hand column reflects the company NTA performance over the period, assuming dividends reinvested, and clearly the difference between the underlying portfolio performance and the company performance is impacted largely by those items I mentioned already, the options dilution being the chief contributor. I'll pass over to Jacob now to make some comments on the investment portfolio itself and an outlook. And I'll just remind shareholders that at the end of this call we'll have some time for questions.
Thanks, Andrew. Just turning to slide 6, we'll quickly recap just our investment approach. As a firm, we're managing just under 8.5 billion in Australian dollars in terms of assets, and the strategy for the listed investment company that the shareholders own is our global long-short strategy. We're really looking as a manager to find 8 to 12 high conviction clusters of opportunity, a combination of longs and shorts. Turning to slide 7, what do we mean by investment opportunity? As a pragmatic value manager, we're really looking for not just stocks that offer us a margin of safety, companies that are trading at a discount to their intrinsic value, but we're also looking in those investments for downside protection, which we describe as multiple ways of winning. And at the portfolio level, we find that conviction is enhanced, as is risk management, by looking for these opportunities in clusters. So turning to slide 8, just setting the scene for some specific discussion around the portfolio. Last year was a bit of a roller coaster ride in markets, as you all aware. We seem to have transitioned into an environment of higher volatility, and ultimately we think that is a reflection of a rising populism, which is driving sort of geopolitical uncertainty, where the root cause of that is simply that the outcome since the global financial crisis for a large percentage of society has been relatively lackluster in terms of real incomes. So the bottom 20% on our calculations in the US have seen their real incomes fall by 3%. So it's not a surprise that we have political polarization, and which is meaning that the running of the economy has essentially been outsourced to central banks. There's very little other, let's call it, policy initiatives that governments seem to be able to get through. And QE, quantitative easing, is a fairly blunt instrument for managing the economy. It's tended to drive up asset prices rather than activity. And you can see that in certain markets. I mean, for instance, even in the US housing market, affordability has become challenged. With the very low level of unemployment in the States would be consistent with a housing market running at about 1.6, 1.7 million units a year, and it's stuck at 1.2 because QE has essentially driven up the price of housing. But you see that repeated, in many different parts of the economy, that dynamic. So QE's inflated asset prices rather than activity, and then that set off a bit of a self-reinforcing cycle where arguably also, low interest rates have sped up the pace of disruption in the economy. Entrepreneurs can get access to cheap capital and develop. We all benefit from innovation, but it's arguably an environment where that's accelerating and once again feeds that anxiety that drives political polarization. Now that's been interesting until the Fed really started to tighten, or the market started to feel the bite of the Fed tightening. And arguably, the Fed has had to tighten more than it would want to because of the Bush tax cuts. The US is running a fiscal deficit of about 3.5% of GDP, whereas the rest of the world is still in austerity mode. At least in Europe and China has been far less aggressive on any stimulus. Now that is starting to go the other way. The US will have to start to tighten from a fiscal perspective, and we think you'll see easing in China and in parts of Europe. But this geopolitical uncertainty on slide 9, you can see, has driven investors into the, let's call them the large, high-quality multinationals. So if you use profitability as a measure of quality, that's companies that you would typify as, have consistently in the top quintile profitability, and now 3 standard deviations expensive. Now, we all want to own high-quality companies. The question is, at what price? And so we would argue it's an environment, and because PE dispersion, so let's call it the spread or distribution of valuation multiples in the market is very wide, it's the right environment for looking for quality in less obvious parts of the market. Turning to slide 10, what does that mean from a sector perspective? Well, it's very clear if you look at the red circle here, those expensive defensives that are found in areas of the market such as the staples, the healthcare, software and internet stocks. That's where that preference for quality is being expressed, and certainly in those stocks outside of emerging markets are relatively expensive. And then on the right-hand side and the far left, you've got the global cyclicals and the more domestic parts of the market, and the domestic parts of the market are potentially more exposed to some of these disruption threats, or simply more country-specific macro, where this geopolitical concerns are seeing investors, sort of essentially, if it's a case of Europe, the avoidance of European banks, or in the case of the US, just being wary about, because the housing cycle is weak, being wary about domestic exposure. You can see those parts of the market have derated. So we're not saying that the quality traders is going to end. In some ways, it's just that I think, as you saw late last year, it may become more volatile because it is so expensive. So turning to our next slide, enterprise software. I think this is a great case study in the Antipodes approach. It is a part of that market that has been re-rated because of the quality of the underlying businesses. But we think it is a classic long-short opportunity, because you've got the incumbent stocks that are actually getting stronger. And 3 years ago, investors were very concerned around companies like Microsoft, Cisco, SAP, around whether or not they could transition from being on-premise license-based providers of software to becoming cloud subscription-based suppliers. And led by Microsoft, that transition has generally been successful. And these are platform companies that have a very strong customer lock. As anyone who has had the experience of using the Microsoft products, there's a tendency to only learn one word processing package, and that happens to be Microsoft Word, or one Excel, and it's been very hard, even with Google effectively giving away versions of those apps. There's been very little traction in the enterprise. SAP, the same. Once SAP is in an organization, it's going to be very hard to extract it. So that lends to pricing power because of the customer lock. There's a natural network effect. Now, if you go to the disruptors, many of the new entrants into software have grown fast, and they've grown fast because of early adoption around fairly, let's call it, new opportunities around in the collaboration. If you look at our next slide, you can see some names there. Companies like Dropbox, GoToMeeting, which is log me in. They had solutions which we needed. That, in the case of Dropbox, it was a storage and solution. In the case of GoToMeeting, it was a collaboration, video conferencing solution. Now, the problem there is they're very narrow. They grew fast. They're very narrow. They're priced for perfection. And what we're finding now that the platform companies like Microsoft are fighting back, and they're starting to really push in. And even the early adopters of some of these companies are now starting to migrate back to the evil empire, and because Microsoft has a solution in Office 365 for collaboration in Teams or for video conferencing in Skype for Business. So we think it gets tougher, and there's been a significant venture capital bubble, and some of that capital and some of the companies that have been born out of that venture capital bubble, as liquidity starts to tighten, investors will start to question the sustainability of some of these business models, which I think will mean there is an alpha opportunity on the short side. On slide 13, you will see there our overall portfolio and the clusters that we're exposed to on the longs and the shorts, and then finally, just a brief description of another one of our levers outside of longs and shorts is the ability to take active currency positions within the portfolio. So really, looking for ways of hedging out of expensive currencies that we may be exposed to via our stock selection, that we wish to essentially shift into cheaper, less risky currency exposures. So it's a third lever in our toolkit for managing risk and driving returns in the portfolio. Slide 15 is an overview of the top 10 names on the long book, and then by sector, our longs and our shorts, and just our positioning in terms of stock counts across the longs and the short books. The portfolio, has in a market last year of relatively high volatility, we ended the year ahead of the market and with our, as Andrew mentioned, with our 60% net exposure. It remains a challenging environment. We went from having one of the worst Decembers at an index level to having one of the best January, Februarys, and from our performance perspective, we have given back some of our alpha in year to date. It's a long journey investing, and when we look at the portfolio, we genuinely believe that the markets are extrapolating around the quality growth trade in a fairly irrational way, and that it makes much more sense to look for the next crop of winners in some of the more neglected areas. With that, I'll finish up and I'll hand back to Andrew.
Yeah, thanks, Jacob. So Lisa, we might move to Q&A now. Any questions from the shareholders present regarding the investment portfolio or the company results?
Thank you, Andrew. Our first question is from Jackie Chang, private investor. Go ahead, please, Jackie.
Yeah, great. Thanks, Andrew and Jacob. Just wanted to ask, how do you expect the portfolio to, react upon resolution or potential resolution of a China-US trade war?
Good question. We've sort of seen opportunities really over the past 6 months, especially coming into the second half of last year, to where you had significant underperformance from some of the more global cyclical parts of the market, be it industrials or commodities, to actually take advantage of, to add some high quality companies at very low multiples. And, I think those sorts of exposures will do well to the extent that there's a positive resolution. To the extent there's not a positive resolution, I think the downside's priced in. Trade has certainly given, uncertainty around trade has definitely hurt probably the Chinese small medium enterprise and also the exporters to China, where the two biggest country exposures on the downside have been really SME, small medium enterprise centric economies, so Germany and Italy. So if there's renewed confidence because we've put trade issues, at least in the short term, behind us, we see also a rebound in the economic performance of core Europe, and we have exposure to core Europe through our European banks, which once again we think are priced for a hard landing, and so any positive resolution would be very much asymmetrically in their favour.
Great, thanks for that.
We do have a further question, Andrew, from Simon Samuel, Delta Asset Management. Go ahead, please, Simon.
Yeah, my question, or two actually, what cash do you actually hold? I can see you're long 89%, or 90% and short 29%, so 60% net long. Does that mean that you're holding 40% cash in effect? And secondly, we've announced a dividend of 2 cents for this half, which is nice, but what is the intended dividend rate going forward? Presumably 5 cents last time was a bit of an exception to encourage the option holders to exercise. So what's the intended plan going forward?
Yeah, I'll answer the first question. It's Jacob Mitchell speaking, and then I'll hand over to Andrew to answer the second question. But in terms of the cash, when you think about the cash, there's if we own, we've got roughly 90% long exposure in the portfolio. So by definition, we have the difference between that and 100 is our cash. And at the end of January, so at the end of January, that number is 5.7%. And then the shorts though reduce our equity exposure. So that's the net, the number you refer to as net 60%. And then I'll hand over to Andrew.
Yeah, so just to clarify, if you think about net being equal to long minus short, so long roughly 90, a bit over 90, short roughly 30, 90 minus 30 equals 60, so that's how you get to a net invested position of 60. In relation to the dividend, so the board intends to pay regular dividends through time, subject to profits, cash flow and available franking credits. The 5 cent a share final dividend for financial year 18 encompassed was the only dividend for that year, so that covers the whole year. We've now, with this first half result and looking forward, and with the generation of increased franking credits through paying tax, etc., being able to make the decision to pay an interim dividend for the first time. The company is still young, but we do intend to pay regular dividends subject to those things I mentioned.
Andrew, we have no further questions in the queue.
Thanks very much, and thanks to all shareholders who dialed in. Just to reiterate, our presentation from today is available on the Antipodes website, antipodepartners.com. If you aren't already enrolled on our distribution list to get regular updates, please feel free to enrol via the website or send an email through, and we look forward to serving you over time. Thanks everyone for joining.